Heikin Ashi charts are a popular and useful way of viewing a price chart for many traders. The other popular charts that you probably already know about are the bar chart, line chart, and the candlestick chart. In this video, we'll first go through what Heikin Ashi is and the formula behind it. Then we'll go through how you can use Heikin Ashi to help you create a strategy while looking at key factors. Heikin Ashi means average bar in Japanese. It was created hundreds of years ago by Munehisa Hama in the 18th century. He was a rice merchant from Japan who is also considered the creator of the candlestick chart. During the 18th century, he made well over $10 billion in today's money. After making a fortune, he became a very important financial advisor to the Japanese government. Heikin Ashi is simply a type of chart like a bar chart or candlestick chart. The key difference, however, is that it uses a formula to construct the price instead of using the actual price. Take a look at the Heikin Ashi chart next to the candlestick chart so you can see the difference. The Heikin Ashi chart smooths out the price action, which helps reduce the noise on the chart and can help analyze trends more clearly. You may have also noticed that each Heikin Ashi bar always opens from the middle of the previous bar because of the formula used to calculate it. Another major difference is the fact that the Heikin Ashi formula includes price information from the past to create the next bar. Much like a normal candlestick, each Heikin Ashi candlestick has an open, close, high, and low. Now we'll go through each of these four parts so we can have a better understanding of Heikin Ashi. The high is simply the maximum price reached, and the low is simply the minimum price reached over the period. The open is the open price of the previous candle plus the close price of the previous candle divided by 2. Lastly, the close is the open plus the high plus the low plus the close divided by 4. Take a look at the summary for the Heikin Ashi formula. Now that we know what Heikin Ashi represents, we can take a look at key factors to consider when using Heikin Ashi. The idea behind Heikin Ashi is it can help filter out market noise to make a smoother chart. The green candles without a lower wick signal a strong uptrend, and red candles with no upper wick signal a strong downtrend. This is important to understand because the main reason why traders would favor a Heikin Ashi chart is to help identify the trend direction and the trend strength. Take a look at the chart example to see a strong bullish trend example, and as you can see, there is very little lower wick on the bars. The technical term used to identify these types of candles is shaved bottom for bars without a lower wick or shaved head for bars without an upper wick. A key factor to determine if Heikin Ashi might be beneficial is if you're a longer-term trader looking to either ride a trend or you're a swing trader looking for large reversals of the trend. For shorter-term traders or scalpers, the Heikin Ashi is often not so useful. The reason for this is because of the way the Heikin Ashi is calculated by finding an average price using previous price data as opposed to the actual price data. If you're looking for long-term trades or investment opportunities, then the Heikin Ashi can be a useful tool to help determine the overall strength of the trend. Using Heikin Ashi in conjunction with a candlestick chart is often used when trading stocks or indices, as they often trend more than Forex markets. Overall, the most suitable use of Heikin Ashi would be for long-term traders or investors in the equity markets. This does not mean a short-term Forex trader cannot find value in using Heikin Ashi, but rather it just means they will likely find less value in comparison. Now that we understand what Heikin Ashi represents and key factors to determine how it could add value, we can take a look at techniques to develop a strategy using it. As we already know, Heikin Ashi is better suited for longer-term traders in the stock market. We will use example weekly time frame charts from stocks for the examples. We also know that Heikin Ashi is useful for averaging or smoothing out the price action. Therefore, we will look at examples of swing trading techniques. A popular reversal candlestick bar for swing trading is the pin bar, which indicates a sharp reversal of momentum if the wick of the pin bar is large. If you're not sure about how to determine the quality of pin bars, then make sure you click on this video link. A high-quality pin bar is shown in the weekly time frame stock chart example is the type of pin bar we are looking for. The pin bar should be closing up within the body of the prior bar, as we're looking to go long only if we're trading stocks or indices. We do not recommend going short in the stock market as there are greater risks with doing so. The pin bar should also have at least a 55% wick to body size and be larger in size compared to the prior bars. Take a look at this other large pin bar example at a swing low to see what I mean by a strong size pin bar compared to the prior bars. Next, we are looking at the location of the pin bar, which should be at a swing high or low point as shown in the example. An ideal location would be on a retracement of an uptrend, as you can see in the example. A reason for using a retracement of an uptrend is because there's a greater chance we won't be fighting against such a large downtrend. For the exit strategy, we can use a trailing stop loss, which can be set based on the Heikin Ashi price action. The trailing stop loss strategy can be based on the Heikin Ashi chart by using 2 consecutive counter closing bars in a row. The stop loss goes to the break after the second counter bar closes. Take a look at the example to see what I mean by this. As you could see, if we're going long, you can place the stop loss a little off the low from the second bearish closing bar in a row. If we were to use a normal candlestick chart to do this, then you would not be looking for such a large move from the market before taking profit. The Heikin Ashi is useful for trailing stop-loss exit strategies as it helps determine the overall trend strength by filtering out excess noise compared to a normal candlestick chart. Take a look at this example to see what I mean by this. You can see the normal candlestick chart using the same exit strategy caught a much smaller trend compared to the Heikin Ashi chart. This exit strategy is better suited for long-term traders or investors. The exit strategy is the part that includes Heikin Ashi. However, this does not mean you can't find a logical way to implement it for an entry strategy too. If your trading preference is to trade stocks or market indexes for the long term, then the strategy ideas mentioned earlier are well worth considering. You should refine the ideas to suit your trading preferences and risk tolerance. If you enjoyed this video, make sure you click the like button as it helps us make more videos like this. Also subscribe to the channel and check out another video about one of Humma's technical analysis techniques. Thanks for watching.